Welcome back to the next chapter of this course. You've now learned about the three core financial statements, about the accounting equation. You know what general ledgers and T accounts are. You are capable of using the double entry principle, and on top of that, you can construct a balance sheet and an income statement. Additionally, you are well aware that revenue and expense recognition may have a different timing than cash payments. We are making excellent progress, so congratulations! These skills alone are what any firm would expect you to know if you start as, say, a junior accountant. However, in this chapter, we're going to delve a little further into financial statement analysis. Essentially, financial statement analysis is a continuation of accounting that uses the numbers that were registered in order to produce meaningful information and provide some less obvious insights into the company's business. After we've created a balance sheet and an income statement, we can start thinking about financial statement analysis. Its main purpose is the assessment of the performance and soundness of four critical dimensions: growth, liquidity, profitability, solvency. Or, said with other words, our goal would be to answer the questions: is the company growing? Does the company have sufficient liquidity in order to repay its short-term liabilities? Is the profit that is being earned satisfactory? Is the company able to face its liabilities? Sounds interesting, right? The people who say accounting is boring are usually the ones who don't understand it.